I've got to get back to the markets on a Friday morning. Mark Havilone with me this morning. Mark, are you looking for a Santa Claus rally? I believe you are. So here's your opportunity to make your case.
Well, good morning. And yes, we saw some bad news or some disappointing stock market news from the Fed chair earlier this week. We saw the markets react, and we see interest rates even have bumped up. But the bad news, and oil prices have risen. We have wage fights that are nasty. But from an investment standpoint, that's good news for investors. You can get all the bad news out now. You can get some of these lofty valuations more reasonable, especially the large mega cap tech. And then as that unfolds and unwinds and we look forward, the market will look forward, and we think by year end, stocks have a nice rally heading into hopefully a good 2024.
Meanwhile, as I often say, what's the problem with a 5% treasury, a one-year treasury that yields actually more than 5%? What's wrong with that while we wait for the Santa Claus rally?
Well, we have talked about that, and you've been on point with that. And in fact, you started with a 4% two-year treasury. So it's even gone up since then. And the good thing about owning a two-year treasury is when rates go up, you don't get hurt as much, because you only have less than 24 months of that old 4% interest right now. So if we talked about that a year ago or 8 months ago, you have about a year left of that 4% rate, and it doesn't get hit hard now that rates are at 5. You can now reinvest maturing bonds at the higher rate. Rolling bonds like that is not a bad strategy, especially for a conservative investor. You're staying in quality U.S. paper, you're staying on the short end of the yield curve, and you're sitting out all this interim volatility.
Okay, I'll sit on 5% and wait for the Santa Claus rally. Sounds good to me. Mark, thank you very much for being with us. Have a great weekend, sir. See you later.